What's up everyone? I'm Professor Stefan, and in today's video we are going to talk about the income statement. So let's get started. Now my goal for this video is to just give you a very brief introduction to what the income statement is, what makes it useful to investors, and give you an overview of the kind of format of the income statement and how you would put one together based on kind of a company's trial balance, based on the account balances that you're given. Now the purpose of the income statement is to report the performance of the company over a given period of time. So how much money did they make, or how much money did they lose? And we're going to try to disaggregate that a little bit to help investors a bit more. So we're going to know, instead of just the bottom line net income, we want to know their revenues, their expenses, a few of the different types of expenses, and so we can get a sense of how well this company did. And we have a very basic income statement formula here, which is revenues minus expenses equals our net income. And so our income statement is just going to take this simple formula and it's going to split it out into, probably 10 to 20 different lines so we can understand kind of the inner workings of the company. Now, what makes the income statement so useful is that it helps evaluate the past performance of the company. And we can use that past performance to try and help us predict the future performance of the company. So if you want to know whether to invest in a company, the income statement, the earnings number, might give you a good predictor of future earnings or future cash flows. And it might also give you some sense of the risks of the company. If their earnings are kind of jumping up and down all the time, if you see some big gain related to some one-time event, you might say, hey, maybe this strong performance isn't going to last. It might be kind of transitory. And so it gives us this kind of window into the performance of the company. Now, some of the limitations of the income statement, which we're going to see with the other financial statements as well, are that some things get omitted if we can't reliably measure them. Accounting overall is very conservative, so we kind of only let companies put things in their financial statements if they're reliable, if we can measure them. And if that's not the case, they might just be excluded entirely, even if there is some economic benefit or cost to the firm. And second, there are different accounting methods firms can choose that are going to affect their income numbers and their balance sheet numbers. And so that's why we in this class try to teach you these different methods so you'll be a better evaluator of these financial statements when you go out into the real world. And finally, just like a lot of the numbers we're going to deal with in this class, there can be a lot of judgment involved by managers. And so you need to understand kind of where these estimates come in, where these judgments come in, and how they might affect the bottom line of the company. So regarding the format of the income statement, companies have two options that they can choose from. And the first is what we're going to call a single-step income statement. And that's going to give us kind of two broad classifications where we're going to group our items. The first one is all of the revenues and income that the firm earns. So it could be revenues from operations, could be interest income, all that kind of stuff goes up at the top. And then the second is all of our expenses. So we list all the expenses below all of the revenues and inflows. And that is going to give us an income before taxes. We're going to list our tax expense on that money we've made, and we're going to end up with net income. So the second option that firms have is to use a multi-step income statement. And all that means is we're going to have kind of more sections that might tell us a little bit more about the operations of the company. And so the big difference between the multi-step and the single step is that the multi-step is going to have kind of an operating section. So what are kind of the normal operations of the firm? And then it's going to have a non-operating section, which is kind of all the incidental stuff that goes on that might be kind of unusual or infrequent or transitory that you might not want kind of mucking up sort of the normal operating results of the firm. And so we're going to start here with kind of our revenues and our cost of goods sold, where the cost of goods sold is just all the kind of direct costs that go into generating those revenues. So out of that, we're going to calculate our gross profit, and then we're going to get into our other operating expenses of the firm. So these could be R&D expenses, advertising expenses, general and administrative stuff. So all the stuff a company does have to spend money on, but it's not directly related to the goods or services that they sell. And after those operating expenses, we're going to get into that non-operating section that I talked about that are kind of these other things the firm might be involved in. And they could be one-off restructuring charges. It could be interest income or interest expenses. It's not directly related to the operations of the firm, but it is changing how much money they're going to make or lose in a given year. And we separate these out just to give investors a better idea of how the firm is really performing. Now at the bottom of this income statement, we have the same few lines that we saw on the single step. We're always going to have our income from income before tax. We're always going to have our tax expense, and then we're going to have net income, which is that after-tax income. So let's dig in just a little bit into what makes something operating versus what makes something non-operating, because that's kind of an important distinction here for this multi-step income statement. Our operating items are things like revenues, the cost of the goods or services that we sell, advertising, the cost of the accounting department, the cost of the CEO, their salaries, all this stuff that is related to the sort of normal operations of the firm. Now, the non-operating revenues and expenses here are sort of secondary to the normal business of the firm. And these could be interest expenses or interest revenues. Those are very common ones that you see. If they sell some investments they had held and had a gain or loss, right? If they're not an investing firm, an investment firm, that would be sort of, non-operating compared to whatever goods or services they normally sell. Or if they undergo some sort of restructuring activity, if that's a one-off thing, you say, well, we don't really want those charges mixed up with kind of their cost of goods sold, their SG&A, that kind of stuff. So we're going to separate it out in this non-operating section. So what is it that makes this multi-step income statement kind of slightly preferable to the single step? Well, it gives us a little bit better of a picture of how the firm is doing. So we get to see that the revenues are paired with the cost of goods sold, and that gives us our gross profit, right? And you hear people on the news articles, all that kind of stuff talk about gross profit all the time, kind of what's their margin on the goods and services that they're selling. And it also separates our operating from our non-operating. So we kind of see, well, the normal business of the firm, how's that performing? And then we also get to see what else is going on that could affect profitability. Is that stuff expected to persist in the future? Or are they more one-time things that we might be able to ignore if we're making future projections? And the kind of goal here is that it lets users of the financial statements sort of make more informed decisions. Now, so what are these formatting requirements? Well, first, we're going to have a certain order of items in the income statement. And these are not hard and fast rules, but this is what you kind of conventionally see. You're going to see revenues at the top, followed by some sort of cost of sales or cost of goods sold. Then you'll get into other operating expenses like R&D, advertising, general and administrative. These other things the firm normally engages in, but are not directly related to those cost of sales. Then we'll get into sort of the non-operating items. And then the three lines you always see are the income before taxes, tax expense, and net income. So then the second question we have is, well, which items actually get separated out into their own line? Do you have selling general and administrative expenses on one line? Do you separate out the selling expenses compared to the G&A? Do you show R&D expenses separately? These are the questions that kind of companies have to deal with when they decide what to report, because there are no hard and fast rules. But what GAAP recommends here is you want to separate out what we call material items. And material just means it's something kind of big enough that investors or other users of the financial statements might care about knowing. If you think about a pharmaceutical company that's developing a COVID-19 vaccine, there's probably pouring tons and tons of money into this R&D stuff. So those R&D expenses are probably pretty big. They might want to list that out separately on their income statement. On the other hand, if you have somebody that just manufactures items, they don't do much R&D, just kind of here and there, they have some small expenses, well, it might not be very useful to see that R&D expense separated out. Now, we always see the tax expense, we always see the income before tax, and net income after taxes. Now, there are a few other items that we're going to see on the income statement when we get into kind of our live class related to discontinued operations. We're going to see earnings per share numbers. So there are some other items that are going to be required to show kind of net of tax. But we'll get into that sort of in the live class. So if we take a look at Apple's multi-step income statement, we can see that it follows this basic structure where we have sales, we have cost of goods sold, and then our gross profit number. We have a list of operating expenses there, including R&D. That's going to give us kind of our income from operations. Then we're going to get into our tax line and our net income. So closing thoughts here. The income statement is going to present the results for a period of time of how a firm performed, how much money did they make or lose. Material items are going to be separated on the income statement onto their own lines. This is usually between 6, 7, 8 to 20 lines on the income statement, but they're kind of shockingly consolidated when you think about it with how much of a firm really engages in economically, we consolidate that down pretty far. Now, the multi-step income statement is going to separate our operating and our non-operating activities and give us a few more subtotals. And there are just a few required lines that every income statement is going to have, which is that income before taxes, our tax expense or tax provision, and finally, net income. Thanks for watching.